All right. You know how complex the financial markets can seem sometimes?
Definitely.
Well, today we're going to try and cut through some of that complexity. We're diving deep into how analysts, how investors actually value securities, how they make decisions.
Yeah.
We've got a bunch of sources here, and they really break down two powerful approaches. You've got fundamental analysis on one side.
And technical analysis on the other, often seen as opposites, really.
Exactly.
And our goal, our mission for you, is to unpack these, show you what they are, sure, but also how they actually work in practice
Right.
and what that means for your understanding of the market,
Yeah.
hopefully helping you cut through all that noise out there, find the insights that matter.
Okay, sounds good. Let's unpack it then. So, our sources point to these two main ways of looking at things. First up, fundamental analysis. What is that exactly? What's it focused on?
Well, fundamentally, this method is all about trying to measure a security's true or intrinsic value.
Intrinsic value. Okay.
Yeah, think of it like peeling back an onion.
Right.
You're looking at everything that could possibly affect a company's real worth.
Everything. Like what?
Well, you start broad, the wider economy,
Yeah.
things like fiscal policy, government spending, or monetary policy from central banks. Inflation's a big one, too.
Right, the macro stuff.
Exactly. Then you drill down to specific industry conditions, and maybe most importantly, you look at the actual or the expected profitability of the company itself.
Mm.
It's really about understanding the causes behind why a price might move. The why.
So it's kind of like being an economic detective. Yeah, digging into the reasons.
That's a good way to put it.
Our sources mention things like classifying industries by their life cycle stage,
Yeah.
From emerging growth all the way to declining. And even using frameworks like Quarter's 5 competitive forces to figure out how attractive an industry is.
Yeah, how much profit potential is really there.
Uh-huh.
It aims to be, comprehensive.
Yeah.
But you're right, there's judgment involved.
Okay, so that's fundamental. Now, the other side of the coin, technical analysis. This is where I think it gets really different, maybe more controversial for some.
It definitely takes a completely different perspective.
Oh, so?
Well, technical analysis studies historical stock prices and stock market behavior. That's its focus. The goal is to predict future prices based on past patterns.
Patterns, okay.
The core belief here is that basically all the influences on the market, they're already accounted for or discounted in the price activity itself.
So you don't need to dig into the why, like fundamentals?
Not in the same way, no. Technical analysts argue that the future repeats the past. Why? Because investor psychology tends to run in cycles and predictable patterns.
Interesting.
So yeah, they focus on the effects, the supply and demand you can see in the price, rather than the underlying causes fundamental analysts look for.
This sounds like spotting those patterns then. What kind of tools do they actually use?
Exactly. They use things like chart analysis quite heavily,
Right.
looking for support levels where prices tend to stop falling, or resistance levels where they stop rising, or specific chart patterns. Maybe you've heard of the head and shoulders formation.
Vaguely, yeah.
They also use quantitative analysis tools, things like a moving average to smooth out price data and spot trends more clearly, and even sentiment indicators. Some traders, contrarian investors, actually try to gauge crowd psychology and then bet against it.
Go against the herd.
Right.
So, okay, one looks deep at the company, the economy. The other looks at the market's own heartbeat, its behavior.
That's a neat summary.
But, our sources bring up this really big idea that challenges both, doesn't it? The efficient market hypothesis.
Yeah.
And related stuff like random walk theory and rational expectations.
Ah, yes. The EMH.
What do these theories really suggest about trying to, beat the market using any of these methods?
Well, this is where it gets fascinating, right? Because these theories, especially the efficient market hypothesis, they basically suggest that stock prices already fully reflect all available information.
All of it, instantly.
That's the strong form of the theory, yeah.
Yeah.
The idea is that because everyone has access to information and everyone acts rationally on it, prices adjust immediately. So investors cannot consistently beat the market. It really makes you ask, if all the information is already baked into the price, why even bother with fundamental or technical analysis? What's the point?
That is a powerful argument, but then life happens, right? Our sources also point out there's evidence for capital market inefficiencies. Things aren't always perfect.
Exactly. Information might not reach everyone at the same time, or perhaps more importantly, people don't always act rationally.
Yeah, I'm thinking of things like the 2008, 2009 subprime mortgage crisis, or even that crazy flash crash in 2010, markets seemed to move in ways that felt disconnected from fundamentals.
Driven by fear or panic or maybe mass psychology, and sometimes made worse by, computerized high-frequency trading
Yeah.
reacting automatically.
Right. So putting this all together, what does it mean for you, the listener, trying to make sense of it all?
Well, I think it highlights why both approaches can actually be valuable, even with the EMH in mind.
How so?
Fundamental analysis can give you a sense of the long-term price prospects, sort of an anchor for value. Even if the market is mostly efficient, understanding the fundamentals helps.
Okay, the long game.
Right. And technical analysis can serve a vital role too, maybe more for timing, when to enter or exit a position based on current market sentiment or momentum.
So one for what and one for when? Kind of.
Sort of, yeah. For you, understanding these different lenses just means you're better equipped. Better equipped to interpret the news, understand different analysts' views, and make your own decisions. Whether you end up favoring a more passive investment approach, like just buying index funds.
Which aligns a bit with the efficient market idea.
It does. Or if you prefer a more active approach, trying to find those potential inefficiencies.
So as you look at the markets, it's worth considering this ongoing dance between the deep economic stuff fundamental analysis looks at
The underlying realities.
and those powerful, sometimes seemingly irrational patterns of human behavior that technical analysis tries to map.
It really leaves you with a big question to ponder, doesn't it?
What's that?
In this world overflowing with information, how much of what we see in market prices is truly rational analysis? And how much is just the undeniable, powerful force of collective psychology shaping the numbers we see every day?